The Federal Reserve delivered the expected rate hike this week and projected 5 more hikes by the end of 2019. This was the event markets had been waiting for this week. But President Trump quickly resumed the spotlight as he announced tariffs on $50 billion worth of Chinese imports. This rattled the markets and looks set to dominate the conversation near term. Fed Chairman Jay Powell presided over his first meeting in the role and delivered a rate hike that was 100% priced into markets. The Fed funds rate was raised 25 basis points to 1.5 to 1.75%. Note that this is the first time since 2001 that America's key interest rate has been above Australia's cash rate. Markets were mostly focused on the Fed's quarterly projections. These showed the expected increase in GDP forecasts and a median projection of 2 more rate hikes this year and 3 in 2019. This is a far more aggressive path of monetary tightening than any other major central bank. But markets seem to have been braced for an even more hawkish path, such as the Fed planning to raise rates 4 times this year. Moreover, the Fed did not raise its inflation forecasts, and Powell said that there was no evidence that inflation was about to accelerate. So US bond yields in the US dollar fell in response to the Fed meeting. This US dollar weakness turned out to be the major source of support for the Australian dollar in what was a difficult week for the Aussie, as it slipped under 76 cents to 3-month lows. Domestic data was actually supportive for the Aussie, with Australian employment rising for a record 17th consecutive month. Total employment rose by about 18,000, keeping annual jobs growth at a remarkable 3.5% over the year. The unemployment rate ticked up slightly, though, to 5.6% as new job seekers entered the market. We wonder how much longer Australia can create jobs at such a historically rapid pace, given that the economy doesn't seem to have really picked up. But for now, we take it as good news that is helping support the Aussie dollar, which might otherwise be coming under considerable pressure. This includes commodity prices, with iron ore down from nearly $80 per tonne at the start of this month to only about $67 this week. There is also growing concern over a potential trade war started by the US. At the G20 meeting in Argentina this week, the US vetoed the statement's traditional pledge not to pursue protectionist trade measures. And on Thursday, President Trump announced that within 15 days, between $50 and $60 billion worth of Chinese imports would be hit with tariffs in retaliation for China's alleged intellectual property theft and other trade practices. China has already announced plans to retaliate with tariffs on US imports and will take legal action against the US at the World Trade Organization. US businesses are overwhelmingly opposed to all the US tariff announcements so far. After all, a tariff is effectively a tax hike on business, and in a world of deeply connected product supply chains, tariffs can have unintended negative consequences on the country imposing them. Little wonder the US stock market is down about 4% over the past week, and currencies of trade-sensitive countries such as Australia and New Zealand have been the softest over the past week. It seems that trade tensions will remain a key topic in the week ahead, especially for the Aussie, where the local calendar is extremely quiet. The New Zealand calendar looks a little more interesting as Adrian Orr takes the reins as RBNZ Governor and signs a revised policy targets agreement. The US data calendar is low-key, leaving attention on the various speeches by Fed officials as they elaborate on the policy outlook and, of course, on the latest in global trade wars. This is not a great environment for the Australian dollar, though at least the US dollar weakness after the FOMC meeting helps limit its downside against the greenback. In the week ahead, if these themes remain intact, the Aussie should trade mostly within a range of 76.50 to 77.50. We'll speak to you after the Easter holidays.